I have no idea what he just said. So it looks like you all came back. You weren't upset by that first bit. It is what it is. So now let's put you back together and spend a couple of hours looking at what we're going to do. As I've said at the start, all I've done for 23 years is built businesses that work with accounting firms. That's all we do. And what we've observed over the years is that most accounting firms are business by default. They're built by default, not by design. They just happen. They just grow. They happen. You start your firm. You may leave another firm to start it, and it just happens, right? And all of a sudden you've got some clients, and then you've got some team members because you need to employ some people to deliver the work. Then these services that you've got, they're doing whatever they're doing, what you have to deliver. And then your numbers turn in, and your numbers, well, some of them suck. And then business life is not so good. Business by default starts with clients. Business by design goes the other way. You see, you've got an opportunity. You've got an opportunity to redesign your business model. The average age of an accountant here in Norway is 54 and a bit years old. The average is over 50. This is an older profession here in Norway. I'm going to suggest those that own a business. Hands up those that are the owners, the partners, or the owners of an accounting business. Hands up you are? Great. So about half the room. You're the ones that take the risk. You're the ones that have your signature on documents. You're the ones that get sued. You're the ones that are borrowing the money. All of your team members, I'm talking to the partners here, all of your employees will leave. They all do. Who's always left? You are. So I think as we look to design this business your way, your perfect firm, that you should think of you first, your business life. Up until 3 weeks ago, for 16 years in a row, I was the CEO of my own companies. But 3 weeks ago, I replaced myself because I didn't want to do that anymore. Because I would actually prefer to travel and to speak with audiences like this and have a different life rather than running the business, because that stinks of effort and needs professional skills. Business life. What do you want your business life to look like? Number 2, your numbers. What do you want your numbers to look like? Your numbers can be anything you want. If you want to make €1 million profit per owner, then you can. I'm going to show you a model, by the way, on how you do that. What numbers do you want? Your services. What do you want to deliver? Not what the government says you have to, but what do you want to deliver? You decide. Your culture. Your people around you. Select them. There's 18,000 people that work in this profession here in Norway. 18,000. There's thousands and thousands of great people out there. Some of them just don't work for you. You decide. And then we go hunting for clients. And we decide which clients are going to work with our people on our terms, with our rules, who buy our services based on our numbers and our price, so that we, the owners, have the perfect business life for us. Business by design goes that way. Business by default goes that way. So let's have a look at that. Let's dig a bit deeper as to what I think you need to do to combat disruption. You can't stop it happening, so let's get on the front foot and make it happen for us. I think we need to do 3 things. I think we need to actually crank our profit. I understand that the profit in this profession here in Norway is about 6 to 8%. That is missing a 3 on the front of it. That is seriously not worth the effort. Get capacity without hiring more accountants. Many of you think that we have to hire accountants to get capacity. And then let's grow this sucker. Let's grow this thing through the roof. But you're not going to be able to do that with any degree of speed while ever you follow the old business model. Here is the traditional accounting practice model. You want to grow revenue. We have people power, we need humans. Times productive time, chargeable time, times average charge rates. We have these stupid things called charge rates. Less write-downs equals revenue. That's the mathematical equation for accounting practice. We have labour costs equals GP, less overheads equals profit. What's wrong with this model? This is the model that most of you are under. This is an accounting practice. What's wrong? There are constraints with this model. What's wrong with it? Top line. People. Let's start with the people. So in my career of 23 years in counting, I'll see a 5-person firm. Then a few years later, they're a 10-person firm. A few years later, they're a 15-person firm. Then they're a 20-person firm. Then they're a 25-person firm. The head count went up by 5 times, but did the profit per partner increase by 5 times? Categorically not. What about productive time? If you have ever promoted the following, I want more chargeable hours out of you. I want more billable time out of you, more billable hours. No worries, boss. I'll just go slower. I'll make mistakes. You got your chargeable time. If you write it off, that's your business. Fundamentally flawed. Then there's a stupid thing called a charge rate. How on earth can a charge rate value what you know? What does that model sell? Time. What do you actually sell? What do you sell? Knowledge. You sell what you know. That is a labor for hire business model. And it's at odds end with what you actually sell. And for years, and this model does not produce much in the way of profit because it all goes out the door in labor costs. And for years, I've been looking for the culprit. Who invented this stupid model? Last November, I found him. This geezer right here. His name was Reginald Herbert Smith, He passed away in 1966. In 1919, he invented, as a lawyer, the billable hour, and somehow the accountants caught on. In 2 years' time, we will not celebrate this business model. Why on earth would you operate a business model, an outdated one developed by your great-granddaddy? This is a last-century business model. That's an accounting practice. Team, it's time to stop practicing. You've been at it long enough. You should be good at this practice business by now. You've got a business to run, and a very important business to run. So let's have a look at what an accounting business model might look like. So I want to drive revenue for sure. But this model is actually client-centric, client-facing. We understand exactly how many existing clients we have. We have a marketing function to generate leads. We have a sales function that gets conversion rate. We acquire some new ones. We have total client base, exactly what the client numbers are. We have retention rates, so this is a mathematical equation. We have a retention rate model, so we work out how many we lose and why. We have an average project value, average invoice value. Per project, not for the year, that's the average fee per client, but per project, how much they spend. A singular project, an audit is a project, a tax plan is a project, an annual compliance is a project, a forecast is a project, multiplied by the number of projects they buy from you each year. Less labour costs equals GP, less overheads equals profit. This is a vastly different client-centric business model. Why are some in yellow, some in white? Pop quiz. Why yellow, white? They got it in Perth last Friday. Why yellow? Because the yellow ones are the activities that we can monitor, test, and change, and the white ones are the results that we monitor and then we alter the activity. Why do I have yellow shoes on today? And I know they're cool, right? And don't say what someone in Charlotte, North Carolina said last year, because your wife didn't dress you today. No. Why do I have, put that on there, why yellow shoes? Because I want you to remember, with Rob's yellow shoes, that we need to focus on the right activities that produce insane results. And as we build this business model, there are 8 non-negotiables. And when I say non-negotiable, this is after 2 decades working with you, these are the non-negotiables. If you want to drive profit, get capacity, and grow your revenue, number 1, you must price every single project up front. The client must know, they must sign off for a fixed fee for the project, because time-based billing in arrears incentivizes inefficiencies and padding of timesheets. It's a very unethical behavior. We price up front on all projects, all clients. We value price on special projects. We actually sell what we know based on our contribution to the client's condition. Value price. I'll teach you value pricing in the next 30 minutes. We have a client communication program, a solid client communication program, marketing function. Now, when we price a project up front, What are we directly incentivized to do? Hello? Be as efficient as we possibly can. We now are incentivized to automate. When we're fixed fee of, €5,000, whatever it is, we've now got a fixed fee. How do we dramatically reduce the time and pick up the margin? All clients on cloud accounting. All. It doesn't say some. All. For a number of reasons. One, highlighted earlier on this afternoon, sorry, that you become infinitely more efficient. Awesome, right? That's part of an efficiency strategy. But here's the real reason. You've got direct access to the real-time numbers, so you can be the real-time accountant and you can actually advise based on the numbers. Numbers-based advice. Switch them all across. Mandate it. Unless you are going to on these 2 platforms, 3 platforms in the next 2 or 3 years, you will not be a client of this firm anymore. You see, it's not your team member's business, nor is it your client's business. And if you're going to take the front foot and be the leader, then shouldn't they abide by your rules? Marketing that works. If you're going to free up 50% of your capacity and be more efficient, it's not going to refill itself. You'll need marketing and sales skills. And you'll need a broader range of business advisory services as well. So let's have a look at that in action. Right? Let's have a look at that model with those non-negotiables in action. So I've picked a business here. I just took a stab at it. I didn't know what size businesses you were. €2,079,000. You might be 200,000. You might be 200 million. It doesn't matter. This is an equation that works for every single size business. And let's say you've got 35 existing clients. And we do some marketing. We generate 50 leads, 70% conversion rate, 35 new. Therefore, ending market's 420. 90% retention rate. We worked out they're spending $27.50 per transaction, and they're buying 2 things from us per year. That's a mathematical equation for $2,079,000. We might have labour costs of $950, gross margin here of 1.1, overheads of $429, profit of $700,000, 2-partner firm, $350 apiece. Not bad. It's not a million, but it's not bad. Now what we're going to do is apply what's called Rob's Rule of 3843. Here's how it works. What we're going to do is increase the client count by 5%. Plus, we're going to increase the retention rate by 3%. Plus, we're going to increase the price per project by just 10%. Plus, we're going to grow the number of projects per client by 20%. There's your 38, and that will equate to a 43% increase in revenue, 42.76 recurring. So when I first developed this model, I started with 42.76 recurring. Why? Because if you increase, and I rounded it to 43, I hope you're okay with that. If you increase your revenue by 43%, you double the revenue every 2 years. That's a good benchmark. So let's have a look at how that might go into play. So this particular model, we had 35 clients. We had now 70 leads, because we need some more clients, 80% conversion rate. There's your 5% there from 420 to 441. We've got 92.7 and 3 points on that. 3,025, 10 points on that, 2 to 2.4. Now that equates to, with those small changes in the right area, 2.967 million in revenue. Who in this room, and I definitely need a hand up on this one, who has approximately 900,000 euro in revenue? Who's got approximately 900,000 either side of that? Someone has. Oh, you have. This one here, right? How many people do you, what is the approximate revenue?
For the entire firm?
For the firm, yeah. 250 million. Okay, so that's 20 million euro.
Yeah.
So who's got around 900,000 in euro? Around 900,000? You have. No? Who's got? Someone's got around 900,000 in euro. You have. How many people do you employ? 5. So your revenue is about 170,000 per. So it's you plus 5, or is it 6 of you? There's 5 of you or 6 of you? 5. Okay, 5. So your revenue per FTE, for full-time equivalent, is sitting around the 170,000 per person. So if you were to grow by 900,000 on your current business model, you would have to hire another 5 people. Don't like that plan at all, because that's a labour hire model. Instead, we're going to get super efficient, free up the capacity, but we might hire a couple more people, maybe some administrative people. And let's say we add 200,000 to the labour costs, not by hiring a bunch more accountants, let's just hire some marketing people. And we increased the overheads by 100,000 as well. And now we've got an 84% increase in profit, and we're looking down the barrel of 640 per partner. Far better numbers under a different business model. And heading towards €1 million profit per partner. €1 million. I like this number. I believe you're worth it. I believe that the owner of an accounting business who's taking all the risk, who adds tremendous value to their clients, should be making at least €1 million per year. Who's with me on this one? Hands up if you are. Yeah, all right. So, how does that look? So, I've got a model for you here. By the way, you couldn't come to an accounting conference and not have an equation, could you? You have to have an equation. You will not need your calculator. This does stack up if you want to add it up to you. So, let's say one partner, one owner. And in this case, we're going to hire 4 accountants, 3 admin and marketing. It's a little 8-person firm here. By the way, if you've got 5 partners, multiply these numbers by 5. And so on if you've got 10 or 20 partners. I see BDOs here with a bunch of people. Client numbers, say 200. Average project value, let's say 2,200, so you measure it. 4 projects per client per year. It gives us 8,800 per client. That gives us revenue of 1.76. Very difficult to do more than $1 million in profit if you don't do more than $1 million in revenue. Salaries. We want to keep our salaries low. We want our GP into the 70s. I find out you've got a pricing problem over here, so often your GP is nowhere near 70%. When I say GP, all salaries, not just accountants. Our top performing firms get GP into the 80th percentile. We want our overheads low as well. Say 310, 760 in cost, voila, $1 million profit. We want our profit before partner salaries well into the 50th percentile. Get this. It's very easy to prop up profits in an accounting practice. Just get the partners to do more chargeable time because they've got the highest charge rate. That is an accounting practice, fundamentally flawed. We're going to have the partners do far less chargeable time. And the partners will follow, hopefully, the 30-60-10 rule. 30%. About 500 hours for partners. About 500 hours of client work, only on value-based fees. No timesheets, no charge rates. You can keep timesheets, but partners, value-based fees work. No compliance for partners. 30%. 60% of partner time should be in a sales capacity. New business. 10% of partner time should be a leadership capacity. Today's a leadership day. You know, what you learn and when you implement, that's all about leadership. Team members. We do not want to work you hard either. About 1,200, 1,300 hours maximum for the year. We're not going to drive chargeable time up. We're going to drive chargeable time down, but the numbers we are going to drive up are the bottom 2. The bottom 2 are the magic numbers for an accounting business. And that is the average hourly rate, in this case 316 for client hours and 130 for all hours. Magic numbers. Who in this room knows their average hourly rate for the month of May? No one. Yet this is the magic number. You do €1 million in revenue, you do 10,000 client hours, therefore 100. This is the magic number. And I'm going to show you over the next 36 minutes, according to the clock, how we drive these magic numbers down the bottom. And how we get our profit, not from 6 or 8% after partner salaries, but 30, 40, 50%. You okay with this? Yeah? You don't make enough money. Turn to your seat neighbour and say, we don't make enough money. Do that now. So let's start with profit. We've got 3 topics: profit capacity and revenue growth. We'll do profit now, and then after the break, we'll do capacity and growth, okay? You can take notes, or I believe Oyvind has said that the slides will be available, which is great. I presume there's going to be a recording available. Take notes, what do you want to do? So, how do we create profit per client? Here's how it works. Number 1, the old way, it took 28 hours to complete the task. You had a charge rate of, say, 175. Therefore, the price popped out the end at 4,900. Time-based billing in arrears was the old way to do it. And whatever the price popped out the end was what the price was. We're going to flip it around. Now what we're going to do, line 2, we're going to price this project in advance. Maybe the same price, maybe a bit of added value, but let's say same price. Now when we've got same price, we've got a price fixed, what are we incentivized to do? reduces hours. So how do we now, because we're incentivized to automate. See, the cool thing, when I was going through that disruption talk, technology, automation, the robots, all this sort of thing, some of you are going, whoa, hold back, buddy. That's a bit heavy. The best thing about all of this technology is you can dramatically reduce the hours internally. So let's say you automated, and now we took that down to 20 hours. Now, the average hourly rate pops out at the end at 245. We just had a €70 per hour margin increase, but the price remained the same. Now what do? We go back to the client, we sell them something new. On line 1 and line 2, they've already bought it. So they've already bought, with price parity, they know it's about that price. But the next new thing you sell, they have no idea. And when you learn value-based fees, you will actually be able to sell on a different margin. So let's say they buy something worth $3,900. Could be a forecast, could be a plan, who knows? And you use those 8 hours to facilitate that one. And the margin on this one is now $487. And the collective for the client is $8,800. Same 28 hours, but the margin on the client is now $316. Yet the price on line 1 remained the same. How much extra profit did we make on this client? This is an accounting question, by the way. $3,900. Because the labour costs remain the same. And we do this over and over. We sniff out a project. We price up front, we drive the time down, sniff out another one, and do it again. We find another project, we value-based fees, we reduce the time, we automate, we price up front, we do it again and again and again, every single client, every single year. And we double and triple and quadruple and quintuple the profit per client, and the labour costs remain the same. Making sense? Yeah? Looks pretty simple. This is not rocket science, but it is rocket fuel. Because this is what we discovered after coaching like belly to belly. Hundreds, 800 firms directly. Hundreds of firms. And we worked out what works and what doesn't. And in fact, we worked out 30 key strategies, 11 in profit, 8 in capacity, and 11 in revenue growth, how to actually do it. So I'm going to deliver that to you. The first one is price up front, without a doubt. This is number 1 for a reason, without a shadow of a doubt. And as an example of that, you start flipping the model immediately. So when I said this first up, systems you can use immediately. So today is Wednesday. You can literally be pricing up front tomorrow, like Aaron Blau. So Aaron's a small firm in Tempe, Arizona. I met Aaron on August 10 last year. I saw him again about 4 weeks ago in Phoenix, Arizona. And we had dinner the night before, and I said, what's happening, what's been doing? And anyway, 2 days after I first met him on August 10, this little talk that we're having right now, he emails me. And he was a price and arrears traditional accounting practice. He's got like 6 or 7 people, small firm, all right? And he says, immediately I went out and I sent an implementation plan. Now, because he's now priced up front, he figured, well, I might as well charge more. He gets 2 times the fee. Client said yes without hesitation. If the client says yes without hesitation, what do you know? Hello? It's too cheap. It's too cheap. Now the 2 going, this is going to be fun again. So here's a progression chart of all this happening. And so based on your value belief and your value contribution, your margins and 6 sequential steps, your average hourly rate margin will go through the roof. There's a waterline, 3 below, 3 above. You want to get to level 4 as quick as you can, and level 5 as quickly after that. You may never get to level 6, and that's okay. Level 1, you price in arrears, like most of you are today. Your average hourly rate aware. You know what your number is per month, and you simply put the charge rates up. If you were to put all your charge rates up, trust my process on this, if you were to put all your charge rates up tomorrow by 20 euros a person, 20 each, tomorrow, what is going to happen to client feedback? How much feedback will you get? Trust the process, nothing. But if you do 10,000 client hours, that's 200,000 of extra profit like that in 60 seconds. But don't stop there. Go to level 2. We price in arrears still. We have an average hourly rate target. You might be €125 per month right now. You say our target is this 150. We put the charge rates up a little bit. Now we have some new services. But don't stop there. Go to level 3. Now we do some price up front, like a bit of a toe in the water, a bit of a try at it, and now we get these cool things called write-ups. So write-downs, discounting before billing, is a complete waste of money. It's just tearing up cash. Write-ups, you've priced it at $5,000. It used to take 25 hours at $200. Now you may have charge rates. We now do that in 20 hours, which would equate to $4,000. We take the $1,000 write-up. Making sense? But we get to level 4 as fast as we can. 100%. All jobs priced up front with a fixed fee for the project. And you must manage this with scope creep and scope seep. And now we've still got charge rates. Now we can start to be super efficient because we start to pop the margins. But don't stop there. When you start pricing projects up front, why do we need a charge rate? They are surplus to requirements. You've lived on these charge rates since Reginald Herbert Smith in 1919. Gone. What we're going to do, we are going to price up front, get a hang of that, and then we're going to start value pricing and make it one knock an hour. And now we're going to have a time budget. Never, ever give your team members a knock budget. You've got 50,000 worth of time to do this project. And guess what they do? Fill every bit of it. How'd they know? Did they start it, stop it? You said 50,000? No. But just because you've sold it at 50,000, now you can say you've got maximum 10 hours to do it. Because your margin goal is 5,000. Charge rate surplus to requirements. Let me give you an example. Let's do this. I have lots of water here. My props. Okay, I only need one. Cool. 20 years ago, one of your bright entrepreneurial clients, because you're all wondering, I know you're all wondering, okay, get the mechanism, but how do I get to the price? So let's talk about price of water. So 20 years ago, one of your smart clients came to you for some consulting advice and said, I've got this idea about putting water in a bottle and selling it en masse around the world. Right? Meanwhile, you've got some of the best water in the world here. It sort of worked out, didn't it? Yeah? So they said to you, your smart client, I've got this idea, water in a bottle. How much should we charge for the water? How would you, at the accounting business, how would you charge to make the product? And so here's what you do, right? And so, well, here's my advice to you, accountant to client. What we do is we would get the bits and pieces over here, the raw materials. We would assign some people to create the product. Those people would use some technology, but they'd keep time. And they'd keep number of hours and time taken and to make the product. And the client says, okay, I got that, but how do you get to the price? Oh, this is the genius bit. What we do is we take their salary divided by worked hours times by a factor to get a gross margin, and we will then get an hourly rate. What do you mean? We get an hourly rate per person, and then we divide that by 10 to get what's called a unit in 6 minutes, and then we add up all the time, multiply by the charge rate, and voila, price of product. And your client says, what? You've got to be kidding me. How do I know my market will pay that much? So if I go to REMA 1000, I think I got that right. If I go to REMA 1000, how much is a single bottle of water at 600 milliliters? How much? 20? I was told it was 10. Well, I was told it was 10. How much is the same product at the 7-Eleven convenience store? 25. And you're right on the money. I actually bought one this morning just to check. 25. How much is the identical same product at the airport? About 40. How much is the identical same product at the 5-star hotel minibar? And there's only ever 2 of them. About 60. From 10 to 60. Why? This is called circumstance pricing. You see, when you wake up in Las Vegas, as many of you have been, in that 5-star hotel, right, and you're hungover to all blazes, and you just crave for some cold water, you'll pay the $6. Circumstance pricing. Nothing to do with the charge rates. It's what the market's prepared to pay. Charge rate. Some of you with charge rates, right? It's like a status symbol. So client says to you, so how much do you charge? Well, that depends. What do you mean? Well, we've got these charge rate things, and it depends who you use. If you want the junior, they're like 50 euros an hour. If you want the intermediate, they're 80. If you want the senior, they're 150. But if you want me, the partner, I'm like 200. I'm special. Charge rates are the stupidest thing to value what we know. At some point in time, maybe never, you may ditch the charge rates. The timesheets. I want you to get to level 4 as fast as you can. And then once you get the hang of that, get to level 5. Let me tell you about a 14-partner firm. I'm going to give you a big example because the bigger the firms are, the harder they are to change. This 14-partner firm was a price and arrears business, right? Standard price and arrears business. And I was doing some coaching work with them. I said, righto, partners, the first thing we have to do is to change our behavior and price in advance. And they said, got it, Rob, we'll do it. I'm thinking, no, you won't, right? You just won't do it. You've got ingrained behavior of 20, 30 years of pricing in arrears. How are you going to flip the switch and price up front? So I devised a little system. And the system was that I wrote to their clients, they had 5,000 clients, and I wrote a short letter to their clients. And the letter went something like this: Dear client, here at this business called WHK, we've been pricing in arrears like pretty much every other accounting business does. We've decided to change our system. On the 1st of July, which is their changeover date, you will no longer receive a surprise bill invoice from us. As a matter of courtesy, this is how the letter went, as a matter of courtesy, we will actually advise you the price and scope of works, and you'll have to sign off at the outset, and we can discuss it at the outset. Sincerely, partners. They sent that to 3,500 of their 5,000 clients. And instantly, I had accountability. And they did it like that. The change happened immediately. I'll tell you more about this firm in a moment. So I want to price up front. And ultimately, we get to a fixed fee per month. Ultimately, do not do this straight away. Do not add it up, divided by 12. It's a trap for young players. You will get scope creep and scope seep. If you have fixed price agreements for the year right now, you must monitor and measure average hourly rate per scope, per fixed price agreement. Many of you got these things in place right now. It's great for the customer, but it may not be great for you right now. So our first project is price up front. Second one is work in progress and receivables. Work in progress on your balance sheet is straight out profit. On your balance sheet is unbilled or incomplete work. On your balance sheet is inventory, it's stock, right? So we want to get rid of it. Like Matt. Here's Matt Schleter. Matt is an Australian accounting firm. He's been down this road now for 16 years. Started his journey in 2001. And he says, I've got revenue about 1.8 million from 80 clients. Monthly recurring revenue is 125. My WIP days, work in progress, are generally minus 30 and receivables about 5. Lockup, WIP and receivables combined, runs at minus 25. How do you get negative work in progress and receivables? 3 things. You price up front, you invoice up front, and you collect up front. Why on earth would you wait some weeks or months later after the fact to collect? You see, the who makes the rules wins the game, and it's your game to win. Stop letting your clients push you around. Work in progress, straight out profit. That 14-partner firm. There were 2 parts to the letter. Part 1 was announcing the changeover. Part 2 said, you'll notice there's a small invoice attached to clear out the old system. They cleaned their WIP out like that and kept it gone in one go. Next waste of money in this profession, which is straight out profit, is write-offs or write-ons. Write-offs, right? Write-downs, discounting before billing. Little statistic for you. If you are time-based billing in arrears, your team members are discounting an average of 14.6% average before it gets to you. So if you say you've got €5,000, 50,000 knock worth of time to do this, and they'll stop the clock, start the clock, and make a judgment decision, what goes on the clock? 15%. Before you get a chance to do it. This big firm, right? 14-partner firm. They were like the world champions at write-downs. They were writing down 1.6 million, tearing up a year. $1.6 million. Huge sums of money. 8% of their revenue was gone before they could realize it. I said, guys, send me your budget. And so they sent me their financial budget for the year, their forecast, month by month. Line 1 said fees charged to WIP. Line 2, Expected write-offs, 10% per month. I said, look at this, you idiots. You're expecting to fail before you start. And look at that, you nearly hit your target. And then I said, let me tell you something. See this house? 1.6 million. I found this house in their locality for 1.6. I said, you are destroying the value of this house every single year. And unless you fix this, because it's just straight out bad behavior, unless you fix this, then you are going to buy the house in 12 months. I'm going to set fire to the house, and we're going to have a party around the house. In 6 weeks flat, that business, big business, I'll use small and big examples, that business went from negative 1.6 million in 6 weeks flat to positive 500,000, $2.1 million like that, because they priced up front, they drove time down, and pop the write-ups. You see, if you want a behavior change, and writing off is a behavior change, the best way to get a behavior change is to change the system. People say they want change, but they don't want to be changed. So change the system to change the behavior. We're talking about profit here. We're talking about cash. Profit. Services mix. Do you know which services are most profitable? Let me tell you about Brentnall's, a 2-partner firm in Perth, Western Australia. I got a text message from Tony today, actually. Tony Manise and Chris Mandufus. 7 years ago, we started working with them. They had 256 clients, 256 clients. Regular suburban accounting business at 256. And we just said, you know, what services do you want to deliver? And they said, what we really want to do is this. I said, well, let's do it. And so they did. They went to 256 clients and said, this is our minimum service pack. Yes, we must do the compliance, but tax planning as well. But as a minimum, we want to do a quarterly review with you and an annual forecast cash flow plan as well. 256 they visited, minimum service pack. 130 said, we don't want that. We just want the compliance. I said, no worries. Here's a business card of a guy across the road. He'll gladly take you on. We would like you to leave, please. They went from 256 to 126. 130 said no. No worries. But their average fee per client went to $26,000 overnight. They did it again and went from 126 down to 72 with a new service pack. And their average fee per client went to $44,000. Because they said, this is our business, we are the custodians of advice, and so we believe the best thing for you from us is this. So I was running a seminar about 2 years ago in Perth. I was in Perth last Friday. I was telling the story. This guy in the front, he says, Rob, I was the guy across the road. I got there 130 clients. Do you know the average hourly rate per service? Do you know the margin per service, per invoice? That invoice has got 1,200, 10 hours there for 120. That invoice has got 2,400, 10 hours there for 240. Let's do more than that last one and less of that one. The margin per service, average hourly rate per service. Services mix drives profit. Value pricing. How do we get to the price? How do we actually get to the price? Well, would you like to know how, time-based billing in arrears is definitely a mechanism for pricing. It's a bad one, but it is a mechanism. So would you like to know how you actually value price something? Yeah? Okay, the front 2 rows are good. The rest, they can go to sleep, right? We're good to go, right? So here's how you do it. There are just 3 things. Number 1, your value belief. Do you believe you're worth it? Do you actually believe in your value? The first sale, my friends, is to yourself. You must believe in yourself. If you can't believe it, you'll never sell it. Value contribution. Are you actually contributing to the client's improvement? So this level here is what the client can achieve on their own without your help. But with your help, they can achieve that. The gap, the contribution, is what you price. Which means to price in this way, you must first scope out what your contribution is. And then the way you articulate it to your client. Value perception. The way you put it across to them. And when you get all 3 working, when you all get 3 humming, and by the way, in my one-day event, which we're doing on Friday in Stockholm, Monday in Gothenburg, and Wednesday in Stockholm as well, which you're all invited, by the way, we actually do some pricing examples with this size group. It's just difficult to do, so you just have to roll with it, okay? But what happens here, you start to believe in yourself. You know the biggest problem in this profession? The biggest single problem is actually self-esteem and lack of confidence. That is the biggest problem. I believe you're worth it, right? I seriously do. I've seen the magic that you do all over the world. But do you believe you're worth it? Do you really believe? Have you got the guts and courage? There's a six-pack in there somewhere, I'm sure, right? Have you got the guts to price based on your value, not based on your time? So I'm running this event one day, and we're in Queenstown, New Zealand. Many that went to Australia probably went to New Zealand as well. Who went to New Zealand when you're in Australia? Cool. Did anyone go to Queenstown, New Zealand? A couple. Yeah, cool. How good is this place, right? This is pretty cool. So we've got 155 accountants for 3 days in Queenstown, New Zealand at our annual conference. Next annual conference we do is in January in San Diego. We've got Tony Robbins and a bunch of other speakers there. But in New Zealand, 2013, having this great conference, and Ray Taggart comes up to me. And Ray says, Rob, I've got this pricing conundrum. I've got this client project. I'd like some help, like a bit of advice. I said, stop right there. So the next break, I put Ray on the stage. I said, Ray, I want you to tell the audience your project, what your client is, what they do, how you're going to help them, blah, blah, right? And so he does. And I said, right, you lot, price Ray's project as if it was yours. And the range was from $50,000 to $450,000, a 9 times range in the room. He settles on $325,000, wins the day. Unbeknownst to me, in the front row of this event, Graham and Viv Gillard, who I know, running a small firm, $980,000 in fees, dollars that is. What's that in knock? It's going to be about 10 million or so. So not a huge business. Unbeknownst to me, Graham is getting excited. You see, as the prices were coming from the floor, Graham's going, I've got a similar project, but mine's bigger. 5 months later, Graham calls me up all excited. I've just won this big deal, Rob. I just won this deal. I said, Graham, put it in writing. Here's Graham's letter. He says, once we joined, I was just into change. Just because of who I am, he was 68 years old. But once joined, it's changed my process. The changing point for him was Queenstown, when Taggart's were pricing their account and the prices came from the floor, because he's now getting excited from the floor. And so he says to me in this letter, I worked out a fee I thought was outrageous. But after Queenstown, I decided there was no real price except the one I thought was reasonable. And so I came from Queenstown, reassessed my pricing, and then put it to the client. So he's now about to meet with the client. He's about to meet with the client. As you said, Rob, it's selling the value of what it's worth to the client. On the day I met with the client, on rough calculations. Now, by the way, in his briefcase, he had 4 fixed prices. It was a success fee. He had a 7%, a 9, 11, and 13. Not as a percentage, but as a fixed number. So based on the mood of the meeting, this is called mood-based pricing, he pulls out 11%. And he figured the meeting's going well. I'm going to tell him this number at 11%. So I told him the number, put it to the client, nervous as all hell. He looks at me and says, can you just repeat what you just said? This is called sticker shock. So I think I'm down straight sets. Now this line is the most important line in this letter. I repeated the value to him and what this meant to him, which he just told me what it meant to him. So he talked about the project and the contribution, but then he asked a critical question, what we taught Graham to do. If we could help you do that, which we can, what would it mean to you? Now that answer is the client value. He wins the day, right? He wins the day, and he says, it'll never have happened unless you join you guys. I want to thank you profusely for giving us a system to support it's the belief, then a system. He says, I thought we were going on a journey, we just won lotto. I said, Graham, send me your invoice. One line, agreed. Here's the price. How do you know he's an accountant? 40 cents, yes. And you can pay by credit cards as well. See, that's value pricing. But some of you have limiting pricing beliefs. There's chatter going on in your head. For example, our charge rates are in line with others. What's that got to do with squat? Or, I'm too busy to just charge by the hour. Yeah, granted, lazy way to price. Or, it'll probably take X, so we'll charge Y. Or, I can do that really fast. That's the flipping point. You see, 10 years ago, it took you a month. Now you do it in an hour. Why do you charge by the hour? We better write some off. There's too much time on the clock. How do you know? Bad behavior. Change the system. Change behavior. I'm afraid what the client will think. What the client thinks of you is none of your business. That's their business. What if they say no? Awesome, we don't need to do the work. And every no we get is closer to a yes. If you're getting yeses all the time, the price is what? Too low. A few no's are needed. Or this one, my clients never pay that much. How do you know? Oh, I've seen the balance sheet. I've seen the income statement. I've seen the bank statement. They've got no money. Hang on a minute. Whoa, right? This business is doing 5 million knock a year. 5 million a year. There's 100,000 a week washing through the system. They're paying for the lights, they're paying the school fees, they're paying the salaries, the overheads. There's, as an attitude, there's always money available. Your job. Money is not a finite resource. Money allocation is a priority. And your job as intellectual property purveyors who value yourself, who value what you know, is to demonstrate your value and show them why they should be paying 50, 100, 200,000. You may never ever get a €1 million invoice, never. But there's tons and tons and tons of 50s, 100s, 2s and 3s and 4s every single year based on the value contribution that you deliver. You are leaving so much money on the table, Al, like you wouldn't believe. So, value pricing, driving profit. Average hourly rate, this is the number. This number should be increasing every single month. He said it's a measure of your top line price and your internal efficiencies. We need to know what it is. Right now, every single invoice, every single person, every single month. But then we need to move it. Let me give you one more pricing mechanism. Who's got some things? Okay, let's do this. Can you grab that newspaper under there? Those newspapers, please. Right, just grabbing that one, and that one's on in a couple of those. Okay, cool. So, you pick up a fictitious job here. You pick up a job, and you go, that's worth €2,000, no more than 4 hours. You pick up another job. There's a bit more in that one. That's worth €5,000, no more than 10 hours. Because your average hourly rate target is 500. This is called weight-based pricing. Kid you not. I kid you not. An accountant invented that. Because his target average hourly rate, Peter Lacandro, is 500 per hour. So let's just price it and divide it by 500. There's the hours you've got maximum to do that task. And what happens is you get into the M zone, the margin zone, the average hourly rate zone. And it takes 3 things. You must price up front. Tactics and strategy. You must be efficient. Automation. And you've got to have courage. And the more courage you've got, because the first two, pricing up front and efficiency, are very tactical, strategy, efficiency, technology, blah, blah, right? That's tactical. But courage is personal. Do you actually have the courage to do this? Because the more courageous you get, the more your margin is. On Friday, don't tell them, by the way. Al, I know you've got a bunch of your team going on Friday, but they're going to receive courage pills, right? Productivity. We don't want to drive this through the roof, as in billable hours, chargeable time. We just want a healthy mix. Maybe 75, 80% for your accounting team, and maybe 30% for the partners. But drive it down, not drive it up. Driving profit. People development. Do you actually develop your people for profit? Are you actually focused? You have to do 77 hours, I believe, every 26 months. Did I get it right? Is it 77 every 26 of professional development, education? Did I get that right? You told me yesterday. Yeah, something like, we'll go with that, right? 77 hours. Call it 35 hours per year. That you have to do this. Am I good? Right. So I'm just brushing up on my Norwegian tax stuff here. Where do you typically invest the hours? Where do you train your people on? Tax, legislation, Yeah? What about the human skills? What about how to sell? How to have a meeting? How to communicate? How to write a letter? How to price? To train your people. You see, I mentioned earlier on, your training process knocks the stuffing out of them. People development for profit. Client selection. Do you just take them all on because you've got a minimalist scarcity mentality? Or do you have an abundant mentality? And so, you know what? We're going to select them. We can't work with everyone. We've got a finite number of hours. We can't work with everyone. So here's our criteria. Do you fit it? I'm sorry, sir, you don't fit. And be like Brentnall's and let a few go. Half. Some of you might need to grow some for that one. Who knows? Client service. Do you have a model for customer service, or just happened by chance? Customer service driving profitability. And lastly, on one of our non-negotiables was a client communication program. A rock-solid communication program. So instead of just saying you should have one, I've actually got one for you. And this communication program, this process, is all about for the clients you want to keep. All for the clients you want to keep. And this is over 23 years fine-tuning this, working with accounting firms, how they've adapted this and just worked out what they need to do to actually communicate well in advance of getting fees. Number one, we do an annual general meeting. On the back of compliance, every single year, we spend some extra time and talk about the last 3 years, do what's called a business performance review, and do a what-if analysis to plan the next year. Not just present the compliance annual taxation work to them, but we actually talk about the next year as well. A business performance review for free, no charge. Every 6 months or so, we do a visit. Visit by Skype, visit by face, whatever's appropriate for your client. And the objective here is we give customer service, bit of love, bit of hug, new opportunities, add some value. If you visit your agricultural clients, you'll come back with vegetables and baked goods. It's pretty cool. You phone them up 3 to 4 times a year, systematically. I don't know whether you picked it up or not, but the real-time accountant doesn't visit or call, sorry, the redundant data accountant doesn't visit or call me. The real-time accountant visits and calls on a systematic basis. 3 or 4 times a year, how's it going? What's up? Give some love. Send them some emails, some letters, sporadic text. Hey, how's it going? Haven't heard from you for 6 months. What's up? Can we help? And guess what's going to happen? You increase dramatically the level of communication in advance. What's going to happen? You will get so much business, you won't be able to do it. Awesome, get rid of some clients. And we don't charge any more for phone calls, emails, and meetings. I don't know if you do, but we do not ever. You see, let me tell you about Murray, right? Murray's a mate of mine. I'm a keen golfer, right? Yesterday, we had a great day. Went out with Al, we went out with Erland and Orvind as well. We went out to, I can't remember the name of the place, it was called, the country club on the island. Uster, yeah, the cool place. It was a neat day. It was a really neat day. And a mad golfer. So every Wednesday in Australia, who plays golf in this room? Okay, good. Good golfers, cool. So mad golfer, and every Wednesday I play with Murray, Don, and Richard. So when I'm in Australia. And so Murray says to me last year, Murray, by the way, runs, not too sure what it's called over here, but it's called an IGA supermarket, a small supermarket. Do you have Spar Express or something like that here? Whatever it is, right? He runs a big 7-Eleven. And anyway, Murray says to me last year, I'm looking for a new accountant. So I gave him 4 or 5 names. I said, I'm not going to recommend one, here's a few. So he switches accountants. 5 or 6 weeks ago, he says to me, I've left them. I said, what do you mean you've left them? He said, I've left that accountant that I switched to last year. I said, why? He said, because I received an invoice. Now, by the way, Murray is about a $20,000 per year client. So decent client, right? His business does about $5 million, about $50 million in NOC, right? Decent client. He says, I received an invoice for $300 for a phone call. He said, I'm going to leave them. Why would you charge? Why would you put a barrier to doing business with you? Lower the barriers. Give them your 24-hour number. Run seminars, client advisory boards, social media. You increase dramatically the level of communication. And you increase dramatically the level of revenue per client. After the break, we're going to dig into our final two topics of capacity and growth. Let me promise you this, because don't go yet, right? So let me promise you this. If you implement, right, the 8 strategies in capacity, you will free up to, sometimes more, 4 hours per accountant per day. So at the break we're about to have, I believe we've got a few books left, so you can buy those down at the registration desk. I'm not too sure of the break time, but when we come back, we're going to deal with capacity and then revenue growth and how we actually refill the capacity. You enjoying this so far? It's all good? All right, see you after the break.